GDP, a little bit third reading, a little bit backward looking from your perspective. Does this change your view of the US at all?
No, precisely for the reason that this is basically the third reading of data that is by now about 6 months old. So we tend to focus on much more higher frequency leading indicators of US economic activity. However, the one piece of good news is that personal consumption was revised substantially higher. And that is good news because actually over most of 2016, that reading was in the 3 to 4% area. So when we were dropping down to 0.6, that represented a much, this is still a slowdown, a little bit less so.
Yeah, and Alan, as we look towards what the Fed is going to do this year with interest rates, we've still got these jobless claims at multi-decade lows, as John said. This is a tight labour market, isn't it? And so are you expecting the Fed to follow through on market expectations of rate rises?
Indeed. Very tight labour market. And interesting again, you know, when you put that side by side with the GDP numbers, it only gets squared with soft productivity data, unfortunately, which is not a great thing. That said, I think the Fed, yes, will tighten again this year. It looks like in between the last tightening and the next tightening, you'll actually have some balance sheet related tightening. So they'll act on the balance sheet side of things probably in September and then a tightening in December. Another 25 basis points.
What's more important to Chair Yellen, PE multiples or core PCE at this point?
Look, I think they're very different things.
They certainly are. That's not how you get out of it, Alan.
No. Look, I think they're what you're seeing central bank worldwide is an inclination to look past some of the shorter-term inflation numbers in the view that they've created asset inflation, the financial cycle is much more advanced, and therefore, you know, even if we have these subdued PCE numbers, well, we've got to look past them.
Alan, thank you.